Labeled bonds are key instruments in sustainable finance aimed at raising capital for projects that yield positive environmental or social outcomes. The primary categories of labeled bonds are green, social, and sustainability bonds, all guided by the principles of the International Capital Market Association. These principles foster transparency, accountability, and market integrity. However, inconsistencies persist as some issuers do not strictly follow the established guidelines. Second-party opinions and external verification can be useful tools to assess compliance with relevant standards. However, their use is limited and may not be sufficient to fully capture the quality of labeled bonds or how well it fits a specific investor's requirements. Therefore, investors must undertake thorough due diligence when evaluating labeled bonds.
To identify high-quality labeled bonds, two analyses are crucial. First, at bond issuance, assess the bond framework describing how proceeds will be used. And second, a year later, allocation and impact reports should be analyzed to understand whether the bond's impact aligns with its initial goals. When reviewing the labeled bond framework at issuance, inspecting the categories outlined in the use of proceeds is crucial. Vague definitions might lead to unintended financing of undesired sectors. A positive example, on the other hand, involves clearly defined target populations, which ensure that the proceeds benefit those truly in need, like directing educational funds to low-income families. The planned impact reporting section of frameworks is equally critical. Disclosing planned indicators aligned with ICMA standards strengthens investor confidence. For example, we gather the number of people reached with projects financed, or the tons of CO2 emissions avoided. Certain bonds may offer only qualitative reports, which could signal a lack of transparency. At BlueOrchard, we favor engaging with issuers as part of our B-Impact framework. And we push for adopting best practices, especially considering the one-year gap between issuance and impact reporting.
A year after issuance, companies disclose their allocation and impact reports. Allocation reports should clearly show how proceeds have been distributed across various categories to ensure alignment with the bond framework. When analyzing impact reports, it is essential to scrutinize the key performance indicators used. Investors should ideally assess impact per $1 million or euros issued to provide a standard measure across similar bonds. To do so, reporting on clear and comparable indicators is required. A potential pitfall is that some issuers may offer either too sparse or too general disclosure for their label bonds. They may only show project examples or describe the total impact across all their issued bonds. If this is not considered when analyzing the information, investors may over or underestimate the impact funded and the effectiveness of their fund. At BlueOrchard, we reallocate all impact KPIs to bond-level KPIs for fair and accurate attributed impact reporting in our impact scorecard, database, and then consolidated at portfolio level.
Labeled bonds can be effective tools for impact investors seeking credible outcomes in debt markets. However, not all labeled bonds deliver the same impact value, highlighting the need for robust analysis. As the market evolves, investors must advocate for higher disclosure standards and engage with issuers to drive better outcomes in sustainable finance.